Today we're going to figure out why prices keep going up. You've probably noticed that in recent years everything has gotten more expensive. Food, clothes, gadgets, transportation, even movie tickets. In this video, you'll learn why rising prices aren't always a bad thing, what inflation really means, how it affects the economy and your wallet, and most importantly, how to protect your money. Watch till the end to find out how not to lose money to inflation and even profit from it. Don't forget to like and subscribe to support the channel. Price increases are nothing new. Every year we notice groceries cost more, public transport is more expensive, and tech prices sting. Why does this happen? The answer is inflation. That word makes many people nervous, but it's not all bad. In fact, without it, the economy can suffer. Imagine prices never go up. People would delay purchases. Why buy today if it'll be cheaper tomorrow? This lowers demand. Businesses earn less and can't grow. They don't hire. Wages don't rise. The economy slows down, and what economists call deflation begins, but more on that later. For now, remember this: a little bit of price growth keeps the economy moving. Deflation sounds like a consumer's dream. Everything gets cheaper, but it's a trap. When prices fall, people stop spending, expecting even lower prices tomorrow. Businesses lose profit, layoffs begin, people lose their jobs, incomes shrink. Even those still working save instead of spending. Demand drops further. The economy sinks into a depression. A good example is the Great Depression in the United States during the 1930s. Deflation might seem like a gift, but its consequences are devastating. That's why central banks work hard to avoid it. That's also why moderate inflation is considered a good thing. It encourages spending, boosts demand, businesses grow, and new jobs appear. People earn and spend money, and the economic engine keeps turning. Central banks usually target inflation rates of around 2 to 4% per year. That's seen as a healthy level. At this rate, you can plan your spending, investments, and loans. Economic activity stays stable, and the government stays in control. But when inflation moves outside that range, trouble starts. Join our Telegram channel for updates on new videos and articles. You'll find the links in the description or pinned comment. Too much inflation destroys trust in money. People rush to spend, businesses raise prices, and it becomes a vicious cycle. Money loses its value. A real-world example: hyperinflation in Venezuela, where prices rose by hundreds of percent each month. Wages lost value in days, and people spent money the moment they got paid. Currency became meaningless. To prevent this, central banks use special tools. The central bank controls inflation through monetary policy. The main tool is the interest rate. When inflation rises, the bank raises the rate. Loans become more expensive, money is harder to get, people and businesses spend less. Inflation slows down. If inflation is too low, they lower the rate. Money gets cheaper, spending increases. The central bank also adjusts how much money is in the economy. They buy or sell securities, set reserve requirements for banks. These tools help keep inflation within target levels. Here's a fun fact. Why exactly 2 to 4%? That's not random. At this level, people feel motivated to spend without losing trust in their currency. Wages can grow, the economy expands. If the target is too low, deflation risk. If it's too high, people expect more inflation. They start panic buying, companies raise prices, and inflation accelerates. That's why stability and predictability are key to a healthy economy. When inflation is stable and predictable, businesses and households can plan better. Companies build budgets, investors don't fear long-term projects, savings keep their purchasing power. Even foreign investors are more willing to invest in countries with clear monetary policies. The economy becomes stronger, more attractive, and grows steadily. But what about regular people? How do you protect your savings from inflation? Cash in a piggy bank loses value over time. You might have saved $1,000 in 2014, but by 2024, it buys less. Inflation ate your money. To preserve value, you need to invest. A piggy bank isn't the answer. Even a low-interest savings account can lose to inflation. Sure, you earn a little interest, but you're still losing in real terms. For example, if your account gives you 1% per year and inflation is 2%, you're effectively losing 1% annually. In 10 years, your money won't buy what it used to. Investing, on the other hand, can protect your money. Gold, real estate, stocks, these are assets that can outpace inflation. For instance, tech stocks might have grown 8 to 10 times over the past decade, while gold only doubled and bank accounts barely moved. The key is to invest wisely, understand risks, and not act emotionally. Real return is what matters. You might earn 5% per year, but if inflation is 6%, your real return is negative 1%. In other words, you're losing money. Always subtract inflation from your nominal earnings to understand how effective your investments truly are. That's why you might still lose money even with a positive bank interest rate. Your money isn't safe from inflation in a savings account. What matters is purchasing power. Sometimes it's better to invest in assets that grow with or ahead of the market. We've just published a new article on our website. You'll find free content there for beginner and advanced investors about stocks, bonds, and ETFs. Visit now and bookmark the page. Let's dive into the causes of inflation. There are several, each with its own nature. The first is demand pull inflation, when people want to buy more than what's available. For example, a poor corn harvest. Instead of 10 tons, only 3 are produced. People still want corn, competition increases, and prices rise. Classic case of high demand clashing with limited supply. The second type is cost-push inflation, when production costs go up. Say the popcorn seller has to pay more for corn because of the bad harvest. To avoid losses, they raise popcorn prices. Rising costs lead to a chain reaction of price hikes. The third is built-in inflation, tied to expectations. If prices rise, workers demand higher wages to keep up with living costs. Employers agree, but then raise their product prices to cover wage costs. It becomes a loop. Prices rise, wages rise, and prices rise again. The fourth reason is too much money in the economy. Imagine everyone suddenly had twice as much cash. They'd want to buy more, but goods stay limited. Producers see the rush and raise prices. Money loses value. Inflation takes hold. This often happens when governments print money without economic growth to back it. Historically, high inflation has hit many countries. In 2022, the United States, United Kingdom, and Eurozone all faced around 10% annual inflation. People saw it directly in supermarket bills. Even when inflation slows, it doesn't mean prices go down, just that they rise slower. That's painful. Your salary can't keep up, but life still gets more expensive. To measure inflation, economists use the Consumer Price Index, CPI. It tracks how prices change for a typical basket of goods and services. For example, in 2024, the basket costs $30. By 2025, $30.90, a 3% rise. But CPI is an average. Often, prices of essentials rise faster than non-essentials. That's why even with low official inflation, people feel prices going up. Some people ask, why not have zero inflation? But that's risky. It leads to a deflation spiral. People stop spending, businesses collapse, unemployment rises. On the other hand, high inflation causes chaos. The key is balance. That's why 2 to 4% per year is the ideal target. It keeps things stable. Central banks manage inflation with interest rate policy. If inflation rises, they hike rates. Loans get more expensive, less money flows, inflation slows. If inflation falls too low, they cut rates. Loans get cheaper, the economy revives. Balance is everything. Another tool is open market operations. The central bank buys or sells bonds to adjust money supply. When money is scarce, they buy. When there's too much, they sell. These actions fine-tune the economy and influence how banks, businesses, and consumers behave. Governments can also influence inflation through fiscal policy. When inflation is high, they can raise taxes. People have less money to spend. If inflation is low, they can cut taxes or increase public spending. Building roads, hospitals, and schools not only helps society, but also pumps money into the economy. All of this is part of economic management. Inflation affects everyone. To protect yourself, you need to invest. Gold, stocks, real estate. These can outpace inflation. But you must understand the difference between nominal and real return. If your investment earns 5% and inflation is 6%, you're actually losing 1%. Always account for that. A simple example. 3 people each invest $1,000. One buys stocks, one buys gold, and one keeps it in the bank. After 10 years, stocks grow to $9,000, gold to $1,800, and the bank account to $1,100. But inflation eats into those gains. The real profit from stocks is about $8,000, gold brings $500, and the bank saver sees a loss. Idle money loses value. The bottom line, inflation isn't evil, it's a tool. If managed properly, it drives the economy. If ignored, it destroys. That's why it's crucial to understand how it works and use that knowledge. A smart investor doesn't fear inflation. They know how to deal with it. Give this video a thumbs up and subscribe to the channel. You can also support our content through our membership platform. The link's in the description